Now, as investors, we would love to buy stocks that can go up threefold, fivefold, tenfold in value. That's how we could grow $1,000 to eventually $1,000,000. But what's the surest way for that to happen? Well, let's find out in this video. Many stock investors dream of buying a stock that can go up 3 times, 5 times, or even 10, 20 times. That's how they can really build their wealth. And in finding those great stocks, what do most investors look for? Well, they look for new companies. Companies that have not grown big yet, that are going to disrupt the incumbent mature companies. We call them the upstart companies. And oftentimes, I find that investors, they tend to avoid the very mature companies that are already very big, because their thinking is that, okay, the price of this company has already gone up so much, how much higher can it go? And it's already so big, so there's not much growth potential left. So I might as well buy a new company before it becomes big, before it becomes the enormous giant in the room. Now, I'm here to tell you that it makes a lot of sense, and I used to do that when I first started investing. When I first started investing, I thought, okay, how can I invest in the next big thing that will become big, that will overtake and disrupt the incumbent mature company? And most of the time when I found myself picking those stocks that especially were newly IPO'd or new growth companies, most of the time I lost money. And that's what a lot of people have experienced. So I'm here to share with you that, yes, it sounds like a great idea to pick new companies that can grow many, many fold. But I can tell you that if you actually study the markets, more often than not, you'll probably lose money on new companies or on young companies. And the way to make a lot of money, the way to grow your wealth manyfold, is to actually bet on the mature companies that have already proven themselves with a long track record. Here are just a few recent examples. So one example would be Robinhood wanting to disrupt very old brokers like Interactive Brokers. Now, Interactive Brokers has been around for 10, 20, 30 years. They are kind of like the elephant in the room. They are the incumbent. They already have a strong track record. And you'd be thinking, they're so big, how much more can they grow? So I like to pick a new company that's going to disrupt the industry like Robinhood, because that could grow many, many fold. But what happened in the end? Yeah, initially there's the hype, especially after the IPO, like what happened to Robinhood, but then eventually you can see that it collapses. And after a couple of years, since Robinhood's IPO, it's down 76% versus Interactive Brokers up 93% within that same period. Let's look at another example of a young disruptor company trying to disrupt a mature incumbent company. Another example would be Teladoc Health, that was bought by ARK ETF, because at that time they said that it's going to revolutionize the whole medical industry. It's going to disrupt the traditional managed healthcare companies like United Health and all these big mature incumbent companies, because Teladoc is the future of medicine. That's what they said. And what happened after the IPO? Of course, you got that hype that goes, yay, it's going to change the world, and then boom, again, it collapses. And what happens since then? Since it IPO'd, you can see it's down 70%. Whereas the incumbent, the elephant in the room, the mature company with the track record, it's up 142%, United Health. Another example is DocuSign, that went public in 2020. Again, same thing, we're going to go after Adobe. Adobe's been around for too long. It's very mature. It's too big. We're young. We can grow. We can overtake them. We can disrupt them. We're going to kill them. Well, no. They got killed in the end. DocuSign, again, you got an initial hype, and then boom, it's down 59%. Whereas Adobe is up 77% since that point of time where DocuSign started to challenge them. Another example would be Coinbase. So Coinbase, again, a disruptor going after the traditional exchanges like ICE, which I own, by the way. ICE owns the New York Stock Exchange. So people are thinking, okay, crypto is the new future of money, so I'm going to invest in the exchange, going to change the world, disrupt, and sure enough, again, hype, and then down. Coinbase is down 68% from IPO, whereas Intercontinental Exchange, again, the tried and tested, mature, behemoth incumbent, up up 40%. Not fantastic, but at least it's making money. Another example, I still remember back in 2019, I bought Visa, I bought MasterCard. In fact, I bought Visa, MasterCard many years ago, and I'm still holding them. They are one of the biggest positions in my portfolio. And at that time, I had investors saying to me, Adam, why are you buying Visa, MasterCard? They are the old companies. They're going to go out of business. They're going to be disrupted by Square, which is now called Block. They're going to be disrupted by PayPal. They're going to buy all these new companies. They're the up and coming, the upstarts. They're going to grow 5, 10x. Yeah, right. So sure enough, you get, again, the initial hype and then boom, collapses. And now PayPal is down 27%. Square, which is now renamed Block, is down, well, not too bad, but it's down 7%, but basically not making money. Whereas MasterCard, Visa, tried and true, tested up 106% and 90% since 2019. Okay, here's one last one. So another example is FICO. So in the US, most people would get their FICO score, which is credit rating, before they can purchase property, stuff like that. And what happened again in 2021, a new company called Upstart said we are going to revolutionize, once again, the credit rating business. We're going to disrupt FICO, they're in trouble. And sure enough, initially what happened, Upstart had the hype because they're using AI and all this magic that's going to change ratings, right? And FICO initially went down because people had a fear that they're going to be disrupted by this newcomer. But again, what happened in the end? In the end, newcomer dies, down 77%, and FICO's up 106%. One more example. There are so many examples. There are endless examples. Let me just give you one more example. Lemonade. Have you heard of Lemonade? Lemonade went IPO in 2020. Again, a new upstart revolutionized the insurance industry. We're going to do it faster. We're going to do it better. We're going to kill the incumbents like AIG and Allstate and Met. But again, what happened? We got an initial, whoa, hype, and then boom, down 75% on Lemonade. And Allstate, which is one of the incumbent big insurance companies with the track record, is up 52%. I mean, not fantastic, but at least it's making money. Ooh, forgot. One more example. Snap. Snap wanted to, again, disrupt the incumbent Meta, which owns Facebook, Instagram, and WhatsApp. And sure enough, you got that initial hype, and then again, it collapses. And Snap is down 48%, whereas Meta is up 328% over the last couple of years. So again, what's the lesson to learn here? You know, many of us, we love the story of David and Goliath, that David can beat Goliath. And yeah, it's a great story. It can happen once in a while, definitely. But in reality, in the world of investing, I can tell you that most of the time, David doesn't win. Goliath will smash David in the world of investing. So if anything, I would always want to invest onto Goliath and not David. Now, some of you will be saying, but Adam, couldn't I have traded some of these stocks where, I bought it over here and I could have sold it there before it collapsed? I could make a lot of money. Same thing with Upstart. I could buy over here and sell over there, short it, go down. Yeah, of course you can. So what I'm saying is that for many of these smaller companies that are new companies, you can trade them as a one-night stand. You could go long with a stop loss profit target, you could short it. Yes, you can make money trading it, definitely. But it's not something you want to invest in. Remember, there's a big difference between trading and investing. Trading is short-term, stop loss, profit target, get out fast before it collapses. Investing is something you want to hold for a couple of years to let it compound and to multiply your wealth by 3, 5, 10 times. There's no stop loss, you just hold it because it's a great business. So when it comes to investing, I would invest in, again, Goliath and not David's. While new companies can grow successfully and disrupt old companies, the point is that it doesn't happen very often. It is actually very, very rare. So there are cases where it does happen, where, for example, Netflix, a new company at a time, overtook the mature incumbent company and disrupted a company called Blockbuster. So it does happen. But the point is that it's very, very rare. And, buying a new company hoping that's going to happen is like buying the lottery. It's just a very low probability. So being an investor who wants to ensure I grow my wealth, not based on low probability, but based on high probability, I want to buy the mature companies that are a sure thing, rather than betting on the next big thing. Now, you may ask this question, why is it so difficult for a new company to disrupt and overtake and be successful when there's a big incumbent mature company? For a very simple reason, it's all about economic moat. Remember, when I invest in a company, the most important thing I look for, the number one criteria is the company must have a wide economic moat that protects it from competition. And this is something which I learned from Warren Buffett. So when you buy a mature company like Visa, MasterCard, FICO, Meta, they've got a wide moat where competitors find it very difficult to take away their customers. So to do that is very, very difficult. But new companies, unfortunately, they don't have yet a wide moat. They have a very small moat or no moat, and they take many, many years to build that moat. And for them to build that moat and succeed, again, it's very, very rare. So for me, before I invest in a company, there are many things I look for. There are many criteria. In fact, 7 criteria. But 2 criteria out of the 7 are: number 1, I want to make sure that the business has at least a 5-year history of consistently growing revenue, profits, and free cash flow. Remember that ultimately, it is free cash flow and revenue that drives a stock price up eventually. Okay, so we want that track record. And number 2, I want to make sure the company has got a strong moat that protects it from competition. So if you look at Snap, for example, why did Snap not make it? Why did Snap, fail in the end? I mean, they may succeed one day, who knows, but for now, not yet. It's because they're not making money. Look at that. So their revenue is growing, yeah, but they keep losing money. Their cash flow is negative, and they don't yet have that wide moat. So they can't easily compete with Meta, which has a wide moat and has consistently growing revenue in blue, net income in green, and free cash flow in blue as well. Same thing. Why did Upstart start with a lot of hype, but it collapsed? Same thing. Look at Upstart, right? Revenue grew, but losing money. Negative cash flow. Whereas FICO, the incumbent with a wide moat, has got consistently increasing revenue in blue, net profit in green, and free cash flow in blue over here. So the lesson to learn is this: if you want to invest with low risk, stress-free, and have a very high probability of making a lot of money and growing your wealth, it's better to only invest in companies that have at least 5 years of consistently growing revenue, profits, and free cash flow with a wide economic moat. And it is this top 1% of companies that I handpick in my portfolio, that I invest in, that my students invest in, that I teach in my investing courses. Don't be a hero. Don't go for the David and want to conquer the Goliath. Go for the easy one. Just buy all the Goliaths in this world. But some people will say, but Adam, by the time you buy a company that has a wide moat, that has got at least 5 years of consistent profits, revenue, and growth, by that time, wouldn't it be too late? By the time the company would already be so big, how much bigger can it be? That's what people think. But let me show you some examples over here. Now, Visa went IPO as a new company on the exchange in 2008. Now, people always think, hey, I like to buy the IPO. I like to buy when the company is new and young, it's got a big runway. You don't have to do that. Now, if you only bought Visa after it had a 5-year track record of revenue, profit, and cash flow growth, you would have bought it in 2015, only when it became consistently profitable, which means you would have bought it 7 years after IPO. It doesn't matter. Even though you bought it 7 years after IPO, it still went up 4x. You would have quadrupled your money, 342%. How about Amazon? Now, Amazon listed as a new company back in 1997. Now, did you have to buy it when it went IPO? You don't have to. Again, buy Amazon only when it's proven, only when it's got a wide moat, when it's got 5 years of track record. But by the time it happened, it was 2007, which was 10 years after IPO. So imagine if you bought it 10 years after IPO, is it too late? No, because from 2007 to where we are today, Amazon is up 7,951%. So the point I'm making is this: you can wait for it to be a very strong company, a sure thing, and still make 10, 20, 30 times your money. You don't have to buy it when it's still small. Now, some people ask me, Adam, but isn't it better if I bought Amazon when it was still small? If I bought Amazon in 1997, I've made even more money? Why don't I do that? But here's the problem. The problem was that when Amazon was still a small company, how would you know it would succeed? You wouldn't know, right? Now we know in retrospect, looking back, I should have bought Amazon. But remember that back in 1997, there were many Amazons. There were hundreds of Amazons. And 99% of them all died. So how would you know to pick Amazon versus the rest of it? There's no way to know. So for example, over here is a list of so many companies, so many so-called Amazons that are no longer here. They either went bankrupt, they got bought over, or their share price collapsed and never recovered. Take a look. Have you heard of Alta Vista? You heard of Yahoo, AOL? You heard of Sun Microsystems? You heard of Netscape, eToys, Boo.com, Pets.com? Now at that time, Amazon was one of them, and there's no way to know which one would make it. And that's why you want to wait for it to make it first, then you buy it. Because if you bought all of this, 99 out of 100, you'd have lost all your money. I hope you get this point that many new investors don't get, and this is the very common mistake that they make. Warren Buffett is one of the greatest investors in the world, and one of his best investments to date is investing in Apple, that has made him billions and billions of dollars. Now, did Warren Buffett buy Apple at the beginning when it went IPO? Did he buy it when the iPhone was launched? Did he buy it when the iPad was launched? No, he didn't. He wanted to wait for it to be a sure thing. He wanted to wait for Apple to be a company that had a wide moat, that had consistent growth in revenue, profits, free cash flow, that was predictable and consistent. And by the time Apple was strong enough and consistent enough, it was in 2016, which was 36 years after IPO. So imagine, if you buy a company 36 years after it went IPO, is it too late? Is the company too big? No, right? So since Buffett invested in Apple in 2016, which was 36 years after IPO, and in fact, 8 years after it became consistently profitable, so he was already very late to the party, but despite that, his Apple investment is up 700%. He increased his wealth by 8-fold into billions of dollars. So in summary, if you're looking to invest in stocks that can grow your wealth 5-fold and 10-fold in a very consistent, predictable way that's high probability, don't look for the next big thing that's going to change the world, that's going to disrupt everyone. No, look at the sure thing that's already successful, that's right in front of you. This reminds me of a story of this man who left his farm and went around the world searching for diamonds so that he could be rich. And he spent many, many years searching for diamonds and he never found it. And he died a poor man. Eventually, when his farm was sold, the new owners found that in the backyard of his farm had diamonds beneath the surface. Thank you for watching, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.